Capital and revenue expenditure and receipts. Today's learning objective is to distinguish between and account for capital expenditure and revenue expenditure. Let's look at the definition of capital expenditure and revenue expenditure. Capital expenditure is the business expenditure used to purchase or improve assets that are expected to be used in the business for more than 1 year. It also includes the cost of getting those assets ready for use. Capital expenditure is not classed as an expense on the income statement of a business. Now, let's move to revenue expenditure. These are expenditure on running the business. It is clearly linked to a specific time period. Revenue expenditure is classed as an expense on the income statement of a business. Now, let's look at some examples of capital expenditure and revenue expenditure. These are few of the examples of capital expenditure. Cost of buying assets, delivery cost, import cost, cost of installation, initial testing and safety certificate, initial training of employees, legal cost of buying assets. Example, solicitor's fee for buying premises. Now, let's look at few examples of revenue expenditure. Maintenance and repairs, replacement parts, power costs such as electricity, gas and fuel, wages of the operators, operating costs, insurance and rent. The distinction between capital and revenue expenditure is important. When calculating profit, only revenue expenditure is subtracted from the income earned by the business. Therefore, profit will be lower if an item of capital expenditure is included. Some expenditure might include portions of both capital and revenue expenditure. It is important to separate the two wherever possible. Key knowledge. Capital expenditure includes the one-off costs linked with buying assets and improving existing assets. This usually involves expenditure that benefits the business for more than one accounting period. That is, it is long-term expenditure that improves business. Revenue expenditure includes costs associated with a specific time period, for example, wages and other costs paid for a specific period of time. It includes the costs associated with keeping the business trading. In conclusion, capital expenditure impacts on the statement of financial position, whereas revenue expenditure impacts on the income statement.